All right, so we've covered mental framework. It's time to actually dive into some charts. So let's do that. We developed mental framework. Now we're going to begin to discuss market framework. As you guys know, it takes both. It takes two to tango. We're going to take you today, some of you who listen closely enough and pay attention, obviously. Some of you who aren't a student of mine already, we're going to take you from the world of what I call and some of my predecessors call the uninformed trader to the informed trader. And that all has to do with actually understanding markets, understanding this word that I say all the time, context, understanding, being able to speak the language and see what a market is telling you that it is attempting to do. It is a beautiful thing. Here's what we're going to do today. Intro, we're going to dive into the whole foundation behind profiling and structure and looking at things like that. It's called auction market theory, and it's why this stuff works. Okay? Market dynamics is something that I've created, and it's how it works. Some specifics that we can that markets do. We're going to take a look at some charting and setup, make sure you're good to go there. Then we're going to do a quick primer on market profile. We're not going to go too heavy into that, but I'm going to give you just what you need. And then we're going to get into using market profile the way I use it most importantly, which is different than things you may have studied with other people and whatnot. And that is forming, custom composite profiles and how we're going to use those, how it all ties in with our market dynamics and everything. Then we're going to bring it to kind of like getting closer and closer of actually using this stuff, which is determining the narrative as we come into a session and coming up with some if-then scenarios, our hypos, putting it into action. So we're going to talk about why this stuff works, how it works. We're going to give you some primer on getting up to speed for those of you who haven't used market profile in the past. And then we're going to talk about the main tool that I use, will be using, and then we're going to talk about putting it into action. And then obviously we're going to get to our development plan for the week. Steenbarger wrote an article years ago, and it was about how to learn to trade or something like that, right? Step one was bullet point, chapter title, whatever. Start with a framework. Start with a framework. Most people get this very, very backwards, very, very wrong. They start with, where do I press the button to buy or sell, right? They start with technical analysis, books, articles, blogs, looking for that model to trade, right? Some of you may have come to the NADRO methodology course looking for the same. We're going to give you more than you bargained for, really. So most people look for indicators, moving average, oscillator. It's not the answer when you don't actually understand markets, okay? Once we do understand markets, heck, you can develop strategies and tactics within that to use moving averages and oscillators. That they aren't the problem. The problem is how you structure your business around them. Opportunity in general, we need to know, is sometimes present. I think a lot of people get into trading, think that there's, you hear this talk around limitless opportunity and all these things. And a lot of that is true and healthy, but to a very large degree, if you're using anything related to a strategy that has any kind of market understanding and any kind of top-down approach or contextual framework, we know that most often there isn't actually opportunity. And let me say that again, because it almost sounded like I said something else. Most often there is not opportunity. It's very different than just watching a 1 minute chart for your next entry signal. It's extremely different. Linda Raschke, you may have heard of her. This is from her. This is what she said, okay? It's like a quote here. Should put it in quotes. Where to trade? Market profile. When to trade? Volume charts, reading the tape, things like that. I couldn't agree more. I could not agree more. Where do we trade? We're going to use context for that. Where is the best trade locations? Where is risk reward? What is the market up to? When do we ultimately trade? Our lower time frame tools and things that we use. Very important. Building from last week, last lesson. Remember, now that we're aware of how to see more clearly, knowing that it's going to take work to achieve mastery there, now we can begin to ask the question, what do we look for? Knowing that it will also take work to achieve mastery. So let's get into it. Auction market theory. It's the why, okay? It's the underlying theory behind what's going on with all this stuff. Financial markets, whether it's crude oil or the S&P or whatever, it's just like any other market that could exist in the world within reason, right? Local housing market, buying and selling of inventory of houses. Toyota Tacomas, dealers having inventory, wanting to sell them for higher prices, buyers coming in, wanting to buy them for lower prices, supply and demand, blah, blah, blah. Or crude oil, like we said. We have buyers and we have sellers in any of these markets. A couple of key terms we'll get to as we begin to talk about this. Real quickly, it's just really important. The main thing to take away right now is financial markets are not different than you and I buying or selling something between each other on eBay, okay? The same type of emotions, the same type of motivations. And I don't care if it's ultimately machines that make some of the decisions via their programming and that type of stuff, or if it's humans. A lot of it's always gonna be the same, right? So this is what underlies everything that we do with regard to why it makes sense to look at the data visualized or represented by profiles. Okay, so key terms, profile. What is a profile? Quite simply, a profile is just what the representation of the data of all the collection of at what prices, right? This is your y-axis. What prices did we trade at? And then the x-axis is going to be how much was traded at each price, right? So maybe we had one contract trade here. We had 5 trade here. We had 10 trade here. We had 20 trade here. And we had 2 trade here. And we had 1 trade here. How are we going to represent that? Well, we know the prices that were traded. So we know it's going to go from here to here, right? Let's say this is 50 cents. So we traded from 50, 1, 2, up to 53 cents. 50, 49, 48, right? So we traded for a range from 48 cents to 53. So we're going to have that same range to our profile. And then the x-axis, as we said, it's going to be how much was traded at each of those prices. So we might have a little bitty block of 1 right here. We might have our block of 5 right here. We might have our block of 10 right here. We might have our 20, as we said, just going by the data we have right here, 2 and 1. And so there's your profile. And that's what it's going to look like. So that's what a profile is. It's just the graphic that we use to represent exactly what I just told you. The prices and how much we typically trade there. Now, market profile represents how much time we spent at prices. So that's an important differentiation versus volume profile, which we're not going to talk a whole lot about today, looks at the actual volume. But I just want you to know that. Balance is where we have a fat distribution. That's where we have balance. That's where, if we just looked at a price chart, what if we did this? Okay, it's not really any balance because we didn't spend much time and probably didn't trade a bunch of volume at a single price level. But what if we did this? Well, that's a fat balance area, right? That's what the profile is going to look like. This is just going to look like, this. There's no balance. Here we have balance, right? So you can see balance with basic price action and charts and whatnot, but it doesn't do as good of a job. Value is a simple mathematical calculation. When you have a distribution, value is from the point of control, which is a term we still haven't defined, but still, that's the widest part of the profile, the most traded price. From that area, you now find where above and below can we find 70% of the trading. And so typically it'll show you an area like this. This is the value area high, and this is the value area low. Value, 70% of the main distribution area. Okay. And like I said, balance is where we are balancing, going nowhere. What do you think imbalance is? That was the first one we showed. Imbalance is trending, same word. Balance could be congestion, rotational, chopping, any of that, any of those words, right? Okay. Just clearing up some terminology here so we can go forward and keep building. So back to auction market theory, and I'm going to use, people know from the last course I did, I used a Honda Accord example. I'm now the proud owner of a Toyota Tacoma, which I'm in love with, and we're going to talk Toyota Tacomas. So, nice little blank drawing area for us here. Yeah, some of you saw that coming. All right. So, a nice Tacoma typically goes for 30K. So we will have, remember, here's our y-axis. This is prices. I'm actually not going to draw that, but you understand. It could go to 35. It could go to 40, 45. It could go down to 25, 20, 15K. Okay, these are the prices, just like we looked at the first example. And then where are transactions coming in, right? Well, one was sold here, one was sold here, one was sold here, here, here. Some sucker came in and bought one for that. Somebody, their, father-in-law owns the dealership and they bought one for this, right? But those are few and far between. Most of it's going to occur around where the market is perceiving value based on supply and demand and features and all those kind of things. Not unlike crude oil or the forward-looking earnings of all the top 500 companies in the U.S. stock market. And we can take all this data, and as you know already, we can form a profile to just graphically render what all this data is telling us. What prices did it occur at, and how much occurred at each level. All right. Now, let's say that this is our distribution of where Toyota Tacomas are being sold. And just bear with me for this basic hypothetical example, and let's pretend that all of a sudden price starts to go higher, as it has in the past. We're up here where we've been before, up at the kind of the upper extreme that we've seen prices get to, around 35,000. What is the dynamic here that happens between buyers specifically and sellers specifically? What happens? Well, the buyers, we start to kind of run out of suckers, so to speak, right? The buyers start to get weary because they know, whether they know it or not, if you're educated at all in terms of the car that you're looking to buy and you walk onto the lot, you know where they tend to get sold. You know the value area. And if they're trying to sell it up here, you start to get weary, right? Buyers start to get what we call shut off, to use some specific terms from Dalton and those guys. Because you realize this is too much. This doesn't make sense. Nothing's changed about this product to warrant it being that much more. So the buyers get less aggressive, we might say, as well. What are the sellers doing, however? The sellers are thinking, oh man, I would probably sell this thing for $29,000 would be fine. I'm fine with that. I want to sell as much inventory up here at 35 as I can. That's just extra profits for me. Let's move them all. Let's sell the whole lot. Let's go for it, right? So they're, motivated. They're activated. They are aggressive. And so what happens under normal circumstances is you have, let's even go to like the actual structure of an order book. Okay. This is where your bids are. This is the price. And this is where the offers are, right? And let's say here's our last traded price. And so we've got, 10 people willing to sell here. And we have, 10 people willing to buy here. And that's where the market sits currently. Well, up here, what's going to happen? You have buyers who are starting to say, you know what? I don't want to step up to this price level and pay that. In fact, you know what? I'm going to take my 10 and I'm going to go down here because I just wasn't comfortable with that anymore. And you have the sellers who are saying, oh man, I need to go find a buyer because this is very advantageous for me to sell here. And they're going to go aggressively find that buyer, which was here now, and they're going to make that transaction. And so what happens, guys? Price starts head lower. You got buyers who are backing out, not being aggressive. In fact, they're weary. And you have sellers who are very motivated to sell, and they're going to be aggressive at getting whatever they can in these general vicinity of these prices. The exact opposite happens as we drift lower, right? Sellers start to say, oof, this isn't such a good deal for me. And buyers start to get really aggressive and want to buy at those prices as much as they can. And it tends to kind of push it back, just like we did here. These are auction markets, guys. This is a simple example of where value is not changing. This is the way your housing market works. You go look at comps, right? Comparable houses for your square footage and features and all that good stuff. Location, obviously. And you see what others are selling at that price, and that's going to be a benchmark. You're probably not going to get to venture too far from that unless, again, suckers, right? Uninformed people who don't know where that value is, and that's their fault. This is the way markets work, whether it's crude oil or your local housing market or Toyota Tacomas. This is auction market theory in a nutshell. Now, there are more complexities. Things happen, right? Otherwise, the market would stay in a 10-point range. Thankfully not, forever, because value wouldn't change, right? But as we know, things happen, and we had value established here, and then all of a sudden, something changes, and we could go to our Tacoma example, and all of a sudden, the factory accidentally made some with solid gold steering wheels. Well, all of a sudden your steering wheel is worth an extra 10 grand. So guess what? People are going to be willing to pay 10 grand more. We're going to zip up there and we're going to start balancing and establish a new value area for that market. The factory figures out, hey, you know, we really messed up. Let's make sure we get some quality control, and we don't accidentally make any more of those gold steering wheels. And where is price going to go when they make that decision and that market changes? This is going to be a very important next phrase of mine. The market is going to revert to a prior area of established value. Things were normal. Gold steering wheels changes the market. Gold steering wheels go away. It's going to revert to where it was. It's not going to decide, you know what, now that there's no gold steering wheels, you know, we're down here. That's not going to happen. It's going to revert to the prior area of established balance there. Markets do this as well. Financial markets, that is. And we could give a similar example where we headed down for whatever reason. The steering wheels are falling off the cars. They're crappy. We establish lower value here. They fix the steering wheels. We can revert back. This type of thing happens day after day in financial markets because the information flow, whether it's crude oil, whether it's what's going on with Apple and Google and Tesla and all the things that go into equity indices, that information is changing. So people's perception of value is changing. So it's much more complex, but the premise still holds. It absolutely does. The market, the thing is that we don't have to be a fundamental analyst and read all the earnings and look at all the inventory numbers with crude and all this kind of stuff. We can look at what the market is telling us. We can look at where value is being established, where it was being established in the past, and that is beginning to give us some powerful information for understanding that market. And understanding quite simply on an elemental level whether it's currently chopping around within its established balance or whether it's in one of these phases where it's attempting to move and maybe revert to some prior area. We're beginning to understand the market and what it's up to, aren't we? Quick word on value. We talked about it. It's 70% around the point of control. So it's important what we apply the calculation to. So this is a fun little example here. What if we said, you know what, let's get the height. Let's get all the data we can. Guys, we are the next McKinsey firm here. We need to know all the height of all the ants and all the giraffes. It's going to be just groundbreaking stuff. What does this distribution look like if we move it into a profile, right? A distribution is like a profile, same type word in my world. What's it going to look like? You know, typically you look at distributions as a data scientist on like this on its side, right? We look at them like this vertically. Doesn't matter, right? Paul's diving into it right now. So we're going to have a distribution, and this would be low height, right? And this would be tall height. Just, it doesn't matter what the numbers are, right? This is going to be 1 centimeter, and this is going to be however tall giraffes are, 20, 30 feet. I don't know. So what's this distribution going to look like? It's going to look like this. Right? That's what it's going to look like. And what if we said, what's the value area? We run our mathematical calculation to find where the 70% of this fits or whatever. It's probably going to look something like this. I don't know for sure, but it's probably going to look something like this. It's going to kind of find 70% of kind of in between, if you will. And again, to go to our way of looking at it, you got a distribution up here, you got a distribution down here, okay? And then the value area is going to look something like this. Well, guess what, my friends? This value area is utterly worthless. It's utterly worthless. If you want to find some real value areas to this data set, you would need to cut this data in half, pretend they're not connected, and then come in and find a good value area, right? You'd have one like this for this one. You'd have one like this for this one. Those would be big time. Yeah, there's more weight in ants on the planet than there are weight of humans on the planet. I read that recently. Pretty amazing. Anyways, so we would in real terms, we would split a profile, and then we would attach value areas to those distributions, to those areas where there is balance. In the case of a market, we balance up here for a while, and then we go imbalanced and break, and then we balance down here for a while. That could happen within a day. That could happen within a week. It doesn't really matter what your time frame is for any of these examples. What matters here is that you learn the concept I'm trying to teach of it's important that you find balance first and foremost. And then if you've got that, you can find the value area of a single distribution, not multiple distributions within the same time frame. That value area becomes worthless. Identify balance so we can calculate value so we can better understand. Key idea here. It's not actually the current period profile that we care most about. And this is practical trading knowledge here, as well as understanding your housing market or whatever theoretical example we could use. We're mostly concerned with where we're currently auctioning, that is, where the prices currently are. That bid and that ask, that's an auction process. Where is that auction process currently relative to prior areas of established value, especially most recent value? That's what matters. A lot of people get into profiling and they think that here's today's price action, and then over here on the hard right edge, or the right-hand side of their chart, they have the profile for that day's session. I almost never use or look at or care about the current period, whatever it is, whether it's a day or a year, the current period's profile. I look left. I look at the prior areas of established balance and then simply where price is in the current period, auctioning relative to where that value was. Extremely important. So you've probably already intuitively started to get some of our laws just based on some simple examples, but let's go through more of them. Real quick, there's going to be some slight variations between my old laws and these new laws, just some subtle ones. Just always refining and getting to what's most important. Another thing is, for any new students or old students, we don't care what number they are, okay? Now, I know we're probably, and I kept this because it is such a common phrase within our community, Law 10 compression. We're going to keep that, Law 10, because when people say Law 10, they really know what that means. The others, let's not refer to them. Don't in the community say, hey, I think we're seeing Law number 4 here. Well, most people don't memorize what they are by number, including myself. So let's focus on calling them names and things like that as we go forward. So as we begin to understand a framework, this is about market framework, isn't it? We're going to begin to develop an understanding. We're going to begin to see where the risk is and where the reward is right now. And it may be very favorable to you and it might not be. Remember, there's not always good opportunity, but we're going to know. We're going to speak the language, the narrative, as we call it. NADRO, N starts for narrative. We're going to learn to speak the language of narrative, which is really, it's a story. The reason I call it narrative is because it's a story unfolding. We can see what the market is attempting to do as that narrative unfolds. We gain objectivity. We're going to give you laws of market dynamics. So oftentimes, you don't really have much of a choice as to whether you're bullish or bearish. You're developing a framework that tells you you need to be bullish here until this changes. You need to be bearish here until this changes. It's an actual objective framework rather than, quite frankly, a lot of profile stuff that's out there. It's just like, well, this time frame is in control, or this, it's a short squeeze, or like it's very, very subjective. And I think that turns a lot of people off to profile. It's not only going to help us find entries, but it's going to help us manage trades that work or don't work. We're going to have a framework for it because it gives us points of invalidation and where the condition of balance or imbalance changes. It's also going to show us what isn't happening at times. Now, anyone could say, well, the market's chopping around here today, so it's not going down. Therefore, I should be bullish. That logic doesn't hold up. So what I say on this point here, what isn't happening, we're going to call it the real kind, right? Rather than just anyone could say something isn't happening and pull it out of thin air, and it doesn't really mean anything. Ours will. Anything we talk about today, or really for the rest of the course, it's that I may use certain standard timeframes for me because I'm going to show you what I do. But none of this is time frame specific. I could use daily profiles. You might use monthly profiles as a swing trader, right? You might do all kinds of different things. And that's fine. You might use intraday profiles of 15 minutes. I've looked at those before. Guess what? They work. GIGO, right? Garbage in, garbage out. Remember, we first find balance and then we attach value to that. If your balance is garbage or doesn't exist, your value is crap. Garbage in, garbage out. Nothing is perfect, okay? Don't forget the randomness. Don't forget our last lesson. Nothing can possibly be perfect. But the stuff from here on out in the course is quite good. Here they are in all their glory. Let's briefly just run over them and then let's get specific about them. Number one, balance is all we can understand. Period. We don't understand trends, okay? All we understand is balance. Balance is all that exists. Number two, price recently accepting inside a balance area will attempt to traverse, to go across that balance area. Number three, price recently accepting holding outside a recent balance area often leads to continued imbalance or trend in that direction. It's not rocket science. Number three says there is a breakout. If you get a breakout that holds, a lot of times it keeps going, okay? It's not rocket science. Number four, price often retests areas where the balance or imbalance condition shifts. 5, we expect more of the same until proven otherwise. Number 6, price often reverts to prior areas of established balance. You already knew that one, didn't you? 7, auctions are often choppier. The price action is often choppier inside the middle of balance areas. Number 8, there is a spectrum of opportunity, and we're going to teach you based on the language of narrative and understanding what's going on, where we currently are within the spectrum of low opportunity up to high opportunity. Number 9, there is an exception to the traversal attempt, right? What number was that? Number 2. There's an exception, which has its own law. It happened today. And that's where you get a strong point of control rejection. You get a really strong reaction from the point of control. It can negate law 2. And number 10, our good old law 10 compression, which we'll get into. Let's talk about these conceptually, help you understand them before we dive into more and more. Balance is all we can understand. It's all that exists. Everything else is a lack of balance. You either have balance or you don't. But balance is all we can study. Balance is all we can attach value to. Right? This gets us closer to where, as an auction market theory person, as a NADRO trader, as this type of stuff, we trade value. We don't trade price. Price is just an advertising mechanism. But the things we're trading are more closely connected to value and therefore balance. Balance is all that exists, guys. So let's give you some little graphics on understanding these. So we have a balance area. Remember, it's a prior period balance. We'll give it a value area. It's a prior period balance area. In fact, I should even phrase this to say established. Just to remind you, don't use the profile that's developing today. Look at yesterday's profile, right? That's what we call a balance area. Now, some of you may scalp and you may find yourself using more of the real-time profiles, and that's going to be something you can do. The beautiful thing about NADRO is it's all frameworks, and you ultimately get to, I think it's important to first be unoriginal and try and embrace concepts and stay with me week to week and do what I say. But then from there, as you begin to develop, some pretty cool things can happen. And it's important that you do find your niche within the space. Your niche might end up being the same as mine, but that should be more of a coincidence than by design. So back to the slide at hand here. Price recently accepts inside a balance area. That means we needed to have come from outside and recently accept, which is a word we're going to talk a lot about next week. But that just simply means we push far enough inside and hold inside this balance area. When that happens, you'll attempt to traverse. It doesn't matter what else happens here, okay? The market at this point in time, we know, is attempting to traverse this balance area, this value area, to get to the other side. Okay? Price recently accepting outside a recent balance area often leads to continued imbalance in that direction. So it's a recent balance area, right? So we had to be inside here because we were balancing. But if we can accept outside, a lot of times that no matter what happens from here to, let's say, here, a lot of times it's going to try to keep getting imbalanced and to keep continuing that away from here. There's going to be other things that come into play there, but in general, again, it's a breakout, right? You had resistance here, we broke out. These are where trends develop. Price often retest areas where balance or imbalance condition is shifted. So we could take the first example I showed you a second ago, and let's also do the second example. One was the traversal of balance and one was going imbalanced. So the first one is we hold back in here, we get the retest, and then we go to the other side. A lot of times when you break out, what happens? We come back and we retest, and then we continue. I am a pullback trader. Everything I will teach you within NADRO, and ultimately you don't have to do it this way, but the way that it's presented and the way that I time my trades and whatnot, I'm always trading a pullback. And so I understand that retests happen, and probably most of you on this call understand retests happen a whole heck of a lot. It is a thing, so we have a law for it. We expect more of the same until proven otherwise. This is important because a lot of the most trouble you'll ever get into as a trader is some harebrained idea that today's the day that the S&P goes to zero, or whatever the case may be, with your beautiful fundamental analysis, and you're your favorite CNBC commentator has really got your back on this one. Okay. And it's doing this, and you're just shorting all in here because you think the condition should change. You think we should break out, maybe retest and go. But guess what? That's not the current condition. The current condition is balanced. So you're predicting. We are not going to predict as traders. We're going to do what I refer to as trade what is. So this law makes sure that we know there's a law. We need to trade what is until proven otherwise. It's going to keep you flexible. It's going to keep you objective. It's going to keep you in the moment. It's going to keep you out of trouble. Price often reverts to prior areas of established balance. I'm just gonna do this real quick, right? Trading around here. Last week we were trading up here. We break. Where are we gonna go? We're gonna revert. We've done many examples on that today. Auctions are often choppier inside the middle of balance areas. I've kind of drawn this a few times because I can't help but see it and think it because it really is true. It doesn't always happen, but a lot of times if we're, let's say this is yesterday's profile in the S&P and the overnight session didn't go anywhere and we're coming in and we're open right here. This is not going to be a situation where I'm expecting this or this. It's going to be a situation where we were balanced yesterday. Nothing changed overnight. We're probably going to see some chop and some extremes tested and whatnot within this area as long as the condition remains, right? And we're not going to expect it to change. We're going to trade what is. But it's important to know that a lot of times in the middle of areas where there's balance, it's some of the messier sequences, some of the most bar-to-bar overlap, and can be the more difficult places where you really need to be selective about your entries. I had an advanced group mentoring student today. I had them each present some monthly reviews. And one of them had this, I'm doing air quotes right now, epiphany. And I'm not making fun of the guy. We had this exact conversation to his face. He had this epiphany in his monthly review where, you know what? He needs to tone down his expectations for trade management and letting runners run and things like that when we're in the middle of a balance area. And we kind of laughed about it. And we said, that's funny, right? Because that's what we tell you in your very second lesson ever in the Life Natural course, right? But here you are 6 months in and you're focused on so many advanced things and all this other stuff. You've just had an aha moment to get back to the basics, to first do the simple, then be better at doing the simple, then simply be the best at doing the simple, right? There is a spectrum of opportunity. We're probably not going to be able to cover this one all right now because we need to teach you some more building blocks. But, when we have a fresh condition change, that shift from balance to imbalance, or from imbalance that fails back to balance, right? Those early laws that we talked about, those come with pretty high opportunity. Even the reversion ones, I like them just as good. Markets revert more than they stay in balance, so there's more of those trades. They may not come with as high of an expectation for let's just leave a runner on forever, and because it's never coming back. That's not how we view those, but the opportunity is high because it's a good trade. Anything after those events becomes lesser opportunity as it unfolds. That's because the risk reward landscape, right? The risk reward is at its highest at the inflection, right? At the point of the breakout, that retest, right? And as it keeps going, you might have more confirmation that it's indeed occurring, but the longer it goes before you put on risk, the lesser and lesser of an opportunity that is, because that energy is getting expanded, dissipated, and the risk reward is not as good as it was. After some of our laws of market dynamics have been completed, there's even less opportunity. So there's a spectrum of opportunity. And we're going to talk more about this. Remember the exception. I think it was number 9 with an exception to number 1 or no, number 2. Here I am talking about the numbers. I told you guys not to do that. So the point of control, let's call it right here. If we are doing this, we got our traversal expectation. We got our retest. So we got a couple different laws going on. And then all of a sudden we get to this point of control. And I don't mean, because a lot of times you will see a reaction from the point of control. That's not what I mean. So this is going to take a little more nuance, a little more skill to see, but we'll get you there. It's not going to be a focus of ours for this week or anything like that, but we can notice it. Like I said, it happened today, but it needs to be something where you, using shorter term tools, realize that, hey, this is something just changed. Like the order flow, like things changed, and there was a strong, not just a reaction, a strong reaction from a point of control. It can disrupt our law, which had us the expectation of this. Now, all of a sudden, when we get this, we actually have different expectations, and we're actually bullish from this point. A little more of a rare law, a little more of a nuanced one, but still one worth having. And finally, Law 10, compression. This is the only time we ever will anticipate rather than trading what is. Granted, it's going to be trading what is because we have a Law 10 compression, but it's the only time in which we'll position ourselves for a shift in condition rather than, from a purist perspective, trading the current condition and what is. And so when you start butting up against the edge of a balance area, right? So let's say we make our way up here and the sellers show up. And so we kind of expect to maybe get all the way back down here, but that doesn't happen. We come back up here. Okay, you know, sometimes we wick things and head lower or whatever. That might be, you still might be looking for shorts here because we're trading what is. We're looking for things to, I forget the way I said the law, but we're looking for what the current condition to remain. We're not anticipating a breakout. We're balanced, aren't we? So we're expecting more of the same until proven otherwise. That's the way I said it. So again, we reject from the upper edge of the balance and we expect to get up here. Well, guess what? The sellers are super weak and then the buyers are starting to look really strong. And here we are. At this point in time, we can define with that number of rotations and that's going on there, we can say, you know what? It's pretty much a price action pattern, guys. It's not something I invented out of thin air. This is an ascending wedge, isn't it? We are compressing, getting tighter, building energy, pushing into, not going away from. We're compressing into the upper edge of this value area, this balance. That is the only time in which we begin to position for, or at the very least, expect some type of break higher as that energy gets released. Because the market's telling us that. It's saying, number one, we're not going down here to these destinations based on the other law about returning to balance and then reverting across it, traversing the balance area. That's not happening. Not only that, but the buyers are getting, the sellers are getting weaker and weaker. You might even see another like real feeble attempt and then it might go, right? That's Law 10 compression. We'll return to these with real examples. We're already seeing how we might actually understand a market. I hope, if I'm doing a good job here, you're starting to see how we can understand a market, what it's up to. We can develop a bias from these laws, whether we should be looking long, whether we should be looking short, We're not talking about trading, are we? We're talking about context, having a bias, understanding what the market's up to and where that gets invalidated, what it's attempting to do, where that would change. Remember, nothing's perfect. Even this, you could have the most perfect Law 10 compression, and then some bombs start getting dropped in the Middle East and crude oil goes through the roof. It was compressing down in this case, and you're like, oh yeah, this is a short. And it was. But guess what? A news catalyst just changed everything, right? Nothing is perfect. Nothing can be perfect. New information, we'll call it randomness because we can't understand it or anticipate it. And we need our mental framework to be strong, right? So don't get, oh, I've got the laws now, I've got the secrets. Nope, the randomness is still there, guys. Super important. Charting and setup. Here's the things you're going to need. You'll need to be able to chart market profile. Essentially, I can go ahead and tell you pretty much the handful of platforms that can really do. You might have to buy some extra things for like NinjaTrader or like, third-party add-on stuff. But pretty much the tools that will get it done for you is my platform of choice. I get no kickback for saying that. Sierra Chart. NinjaTrader, a lot of people in our community just love NinjaTrader, prefer it, and they make it work. They get all the extra tools they need, and they do that. I'm pretty sure IRT, I don't know hardly any IRT users, but I think IRT can get this done. IRT is an extremely robust platform. Maybe even WindowTrader, right? That's another one that might work. Anyways, here's what you'll need. You figure out what platform you like. Obviously, market profile. Custom session times for those profiles, right? I've seen some that are just atrocious. They have market profile. They might as well not, because I can't choose whether it's a 24-hour profile or just a pit session only profile. I need to pick those hours, okay? Custom tick sizes. It's probably one of the hardest things to explain from profile, but essentially, right, crude oil, for example, it trades every penny, right? 34.02, 34.01, 34.0. I'm not going to keep doing this forever, I promise. Oh, and I just messed up. 33.99. All right, that's enough. So you'll see eventually, because I want my profiles to look a certain way, and I'm very particular about that, which is why I have number 7 here. I don't always, in fact, I essentially never, unless it's a very, very low volatility market, I never do a profile that creates a level for every single tick of a market. That's what I mean by custom tick sizes. So for crude oil, I currently have it set to where show me one block, please, every 3 cents, right? So it smooths out that noise and shows me a TPO tick size. So you got to be able to pick those. Otherwise, you're stuck with one tick. I've seen a lot of crap platforms that's all they do. You need to be able to separate out your profile from this. Say we opened here and closed here to this. You need to be able to flip back and forth between it. Separate it out. I call it splitting out. That's the wrong word. Separate letters blocks into own columns is Sierra's term. You need to be able to split as well, right? You need to be able to say, you know what? I've got a ants and giraffes profile here, and the value area sucks. So I need to split this profile in, maybe H period, which will come to make more sense to some of you who don't know what that is, but it's every 30 minutes. So A, B, C, D, E, F, G, H would be that period. You need to be able to split it to where it'll say, okay, here's this profile and here's this profile, which previously was one profile. And that way we can get our good value areas that we need. Splitting's pretty rare. It's not, we don't want to go split happy, but I'll talk about that. But we also need the ability to merge. This is a must-have. If we have this day and this day, we're going to put them together into one profile consisting of 2 days, and we're going to use that. And then you have to be able to adjust your scales, both on the x-axis and the y-axis. And I'll show you what I mean by that. Not only be able to adjust them, but be able to say, don't mess with my scale, please. Leave my scale like it is. Don't keep automatically adjusting it like automatic scales do. Let's go to the charts. Let's take this. In fact, no. We need to build one from scratch. So I'm going to go to File, Open New Intraday Chart. You can't see this, I know, but you don't need to. I'm going to select the right crude oil chart, October. I'm going to bring that window over to you. So this is a brand new chart. It's a 1 minute chart. It's just, whatever by default. Doesn't matter. What I'm going to do first, I'm going to go to chart settings. I am going to go to advanced settings. And this is just Sierra specific. Some of you, this won't matter. And we need to be able to have, this wasn't a market profile specific need, but it's a platform specific need for me, continuous contracts. And in fact, they need to be able to be back adjusted. And I prefer a volume-based rollover, also back adjusted. Okay, so we're going to apply that. It takes longer to load, it has to do more processing, but it's important for us to have that. We can, name the chart. And for me, most of my market profile stuff, I use pit sessions. So I know for crude oil, I'm going to do 9 a.m. to 2:30 p.m., just 1 second shy of that, for my session times. Remember, we have to have custom session times. And that'll get us started with a good base type of chart. Time frame doesn't really matter. I need to go to add a TPO study. So I'm just going to start typing TPO. Okay, TPO profile chart. Apply. Now, mine looks like I kind of like it to do right now, except for I know that I like a different shade of red right now in my point of control. But other than that, I have this saved as default settings, and so it gives me exactly what I want. For you guys, it's not going to matter a whole lot exactly how you set up the way it looks. I can show you real quick with mine so you can copy it if you like. In fact, I can share a template for everyone so they can do that, but you'll be able to pause this recording. Here's page 1 of settings and inputs. Here's page 2, page 3, page 4, and a little more. And then the colors and things I have, 1, 2, 3, probably nothing else matters, 4, and a little more. Okay, but what is important is that, I like to get rid of a lot of the extra stuff. Initial balance, I'll get rid of that by going to initial balance range and just setting it to 0. So it doesn't show any initial balance. I don't like to highlight the midpoint. There's very few things that I want to see. And in fact, rather than show you all the settings, which you can go back and see, I'll tell you just so you know, I like to see where we open, which is where you see the blue A, because it's the first opening print within a period, which is the first 30 minutes. I like to see where we close. There's a little arrow that shows where we close. I like to see the point of control, which is this red line extending. And I like to see the value area, which is the value area high and value area low of those, extended lines. I do set my point of controls to extend until future intersection, as you can see. But I set my value areas to only go to the, to where the next session begins. Whether or not you use letters like this doesn't matter. Whether or not you use blocks, I can show you what that looks like real quick. Blocks. Who cares what the letters are sometimes, right? Maybe you like looking at just more basic, dumbed down thing. What's also really important, and I will change it back to letters because that's what I like to use right now. With blocks, you do lose a sense of time unfolding, whereas letters, I know that crude oil ends in K period. I can show you here if I split this out. I say split it, but again, letters, blocks, in own column. There you go. First 30 minutes is A, second 30 minutes is B. Just like a 30-minute bar chart. And so I know that K period is the final period. I know that J is the next to final period. So if I'm looking at data and I see J, I get a sense of time of where that built this distribution, this profile. And again, as you can see, my TPO is by default set to 0.03, so 3 ticks for a 30-minute profile. That's the very first setting. That remember I said you need to be able to customize your tick size, and I told you that I segmented crude oil by 3 ticks. If we leave it at 1, it might work okay if we maximize. You see how sloppy it got? Might work because we have such a large monitor here, but even so, it doesn't, right? I get the blocks, see how you can't see them, and this is why I said you need to be able to customize your scales, your axes. What if it looks like this? Is that really going to help anybody? No, it's not. What if it looks like this? You getting a lot of information from that? No, right? Those are extreme examples, but I'm serious. It's a thing. It's a problem. And so if I get this to where we can just the letters don't overlap, it's too wide. And I think this is the way a lot of people look at market profile. You see this a lot on Twitter, a lot of different people using it. Yeah, I mean, we've had a small range the past handful of days, so I can see all those days. That's great. But when volatility is back to kind of normal, 1 tick, oof, like you can't see all the information. It's all elongated and that type stuff. So I want to be able to see what happened on all this here. So I'm going to kind of dumb things down and say, okay, and you don't want to go too far with this. What if we said, show us 20 ticks grouped together? Now we're back to not getting any information, right? So 3 is a good number for normal crude oil conditions, to where you don't overlap your letters or blocks and you get to see nice bit of information on the chart. So pretty simple. You add 1 indicator to Sierra, which is all I can explain to you, but you'll have to use the community if you're using other platforms, especially Ninja. There's plenty of other users that can help you figure that out. I think a lot of them use like Rancho Dinero stuff or things like that. The point of control is, we will get to that in the next section, but it's just the most traded price. That's where that red line comes from. So that's how to set up a market profile chart. Again, careful with your scales, right? I could scrunch this up and now all of a sudden you don't know this, but it looks like crap. Okay. I could widen out the x-axis and now all of a sudden I'm losing a bunch of precious information. I can see the distribution is really fat. So I like to get it to where the letters almost touch, but don't touch. There's a couple ticks of wiggle room in there. You could say this is good or this is good. It doesn't matter. This is all kind of the same here. And then the y-axis as well. Oh, they start to overlap. It's no good. Oh, there's big wide spaces in between them. It's no good. You get it to where it's a nice scale. Now, real quickly within Sierra, how do you do that? You go to, I think the steps are to first right click and select constant range, because you've probably gotten it to the point that you like it. And then after you do that, right click and go to scale settings. And then make sure it's constant range. Make sure this is not keep the last bar within view or something, manual mode, and then uncheck recenter on chart scroll and hit OK, and you will be set. And that way, no matter what happens with volatility or different things like that, I do this with most all my charts. I get a sense of that volatility because my scale is always the same. And for market profile, it's really important because if this was allowed to auto resize my y-axis especially, well, you know, one day they're going to look like this, the next day they're going to look like this, depending on how much volatility there is, and that's no good. So, market profile basics. I'm going to give you what you need, okay? There's so much market profile junk out there. I'm going to give you what you need. I just want to get you comfortable. I just want to get you up to speed so that you can do the things that we need to do and begin using composites and whatnot, which is what our talk's going to come down to today, really. So that's how I just wanted you guys to get set up with some charts, and now I'm going to explain it to you. A profile period can be anything, right? What I've been showing you has been days. In fact, we go back to our settings real quick. You can see in my settings that it's set to multiple profiles of fixed time. The TPO increment is 30 minutes, which we're going to get to, but really the profile is 1 day. We could make these 1 week, right? Doesn't matter. It's up to you and your trading. Our standard, though, what we're going to rely on for this course and this training is daily profiles. And the TPO period we're going to use is the traditional standard 30 minutes. So A period is 30 minutes, B period is the next 30 minutes. And we're going to use pit session profiles for crude oil or the S&P. I typically use pit sessions. I think I've covered that. Some people use 24-hour sessions. I think that's a mistake. I think you can get away with that. It's very acceptable with volume profile. I don't think that works well for inactive overnight and more active pit session market profile. The main features. We have our value area, right? I highlighted that down here. We have our open, which I told you about. The high and the low are obviously just the upper and lower extremes. And the close was that little arrow I told you about. The point of control is that red line. And again, the point of control is just the most traded price. Or technically speaking with market profile, it is the price at which we spent the most time. But those things are really interchangeable for all intensive purposes. Key idea. Once you move to market profile and auction market theory, you begin to see things differently. For example, we just showed you the open, high, low, and close, as well as value areas. The high and low are going to become something that I used to think was like the most important thing. Where was yesterday's high? Nowadays, I could care less for the most part, unless it was a significant feature or it's already a very confluent area that's important. I could care less where yesterday's high is. We're going to focus on trading balance and value rather than where a single price, traded. These things are more robust. They mean more. All right, some more concepts. Balance, you should already know. Balance is where we have a fat distribution being built. It's where the market is ranging, balancing. That's where we have balance. A fat distribution gets built. Excess is the opposite of balance, really. Excess, if we were to use a price action chart, here's balance. And we might form some excess at the upper end of this balance by doing this. Market tries to break out and rapidly fails. This, my friends, is the excess. It's an area of swift rejection. We can see that in a couple different areas. It doesn't always have to be at the absolute extreme of a profile. But in this case, we have nice excess down here on this first profile. And then, which brings us to our third point here. Where do we have lack of excess? Let's look at the other end of this first profile. Look at the top here. There's no swift rejection because, maybe I should have ordered these differently, but we got to go talk about single prints. Down here, we had single prints. There's only J, 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 only a single column of letters. Those are single prints. Single prints occurred there. There's one single print here. There's some single prints there. Single prints here and here. That's all the single prints I can find. And they represent excess, all of them. When you don't have any single prints, you have a lack of excess. Right? Think about it, like a consolidation area from a price action perspective, just a perfect one like this, it has no excess. But as soon as it gets wicked and rejected, now it has excess. A poor high or poor low is simply a lack of excess at the extreme of a profile. That's all it is. And now let's think about things from, let's go all the way back to maybe the Toyota Tacoma auction. All of these things were present, right? We had a balance area, right? Now, we had single prints during a nice normal auction process where value was clearly established and everybody's happy, which means that we had excess at the highs and at the lows. And we didn't have any poor highs or poor lows. But what might have happened as more and more people got really good information and figured out that there were gold steering wheels on some of these Tacomas. Some sellers still don't know, so they're sitting there selling at the upper end of this profile, and the buyers are just bringing it back up here, bringing it back up here, bringing it back up here, because they know value is probably migrating higher here. And the profile shows us this dynamic with a lack of excess at the high. A lack of excess is very important because excess signifies where we have what we call kind of a secure, in this case, low, and we would have an unsecure high. It's vulnerable. A lack of excess signifies that the auction process, remember the auction process where we went higher? What was the dynamic? The buyers started to get weary and say, oof, I don't know about this. And the sellers start to get aggressive and they say, yeah, we need to sell everything we can up here. This may not last forever. And this happens. And what is this? Excess. Excess signifies the end of auction cycles. A lack of excess tells us that it's not done yet. It doesn't mean that 100% of the time, anytime you see a poor high or poor low, it's going to get taken out. But, you know, we can see the very next day here what happened when we had one. And this wasn't cherry picked. I didn't even plan to say this as a part of this talk, but, you know, A period holds the value area and B period comes back and retests it. There's another law. And then B period rips higher and takes out that poor high. And then guess where the balance occurred? Right on top of where that poor high was. And then we break again into the close. So anyways, very important terms. A lot of these are overlapping, right? Lack of excess, we call, poor highs and poor lows. Excess is single prints. We'll connect these two. We'll connect these two. But everything revolves around balance. Remember, we're mostly concerned with the prior areas of balance, but the concept of excess or lack thereof, hint, hint, can help us as we narrow down our focus and get closer to making actual trade decisions here, which, by the way, we haven't remotely come close to talking about yet, have we? But you're already probably thinking like, oh, trade idea. But guess what? We're still just framing context. You can use excess as a backstop for a trade. I'm more comfortable getting into a trade. Let's say there was some balance. If I'm going to get long and I start to get long right here, I feel pretty weird about it. Why is that? Well, that's because we got a poor low. We got lack of excess down here. And so the auction cycle to the downside is potentially, and probably not complete. What about getting long here, right? Maybe like right here. Now that's a better long. We've cleared out that inventory. We've run those stops. We've created excess. I can use that as a backstop to get into a trade. I'm going to feel better about it, more confident. We can also use lack of excess as a check in our favor. Think about it. In this exact scenario where we're getting long right here, what do the upper end look like? Oh, lack of excess. Probably not done up there either. So if you have excess created at the low and a trade opportunity to get long and a lack of excess at the other end of the distribution, well, guess what? That's a beautiful place to let it go, at least clear that out and take some profits as that happens. And if all of this had occurred inside of a single day, and let's draw it as a profile instead, actually. A period, B period, C period, D period. Here's the excess at the low. E period. Here's F period. Maybe G period is the one that kind of pulls back where we get long. Well, we have, in fact, sorry, let me make it like, just for the sake of this example, to be specific about a micro poor high, poor low. We had B period and D period right here at the same high. And let's say this one did it too. We had 3 TPO periods, which formed the exact same high. And we've got nice excess at the low. We do have some excess at the high, but we have a micro poor high. A micro poor high is one that occurs inside the extremes of a developing profile. You typically need to, you can see what's called a ledge, where there's like B, D, E all like stacked together. But really the best way to see it is to expand the profile like I've done here and look at them each in their own column so that it's very easy to see where there's a micro poor high or low. You can use that as like a mini poor high. There was a lack of excess on those retests into those highs, even though it's not the ultimate high. Doesn't matter. There was a lack of excess right here as we retested that. And so if we're getting long, we're going to expect that the first thing to happen is that micro poor high to go and be taken out. We don't know what's going to happen after that point. Hopefully we have some higher time frame context, which is the real reason for getting long here. And then the micro poor high is just a kind of a first stop along the way where it would be nice to take some profits. Isn't there a lot more to market profile? You betcha. But is it necessary? Is it usable? Is it objective, or is it that ethereal type stuff I was talking about? Okay. I think you know my answer to all that. So let's get into real examples of laws of market dynamics. Balance is all we understand, okay? There's very stark differences between day 2 on each of these examples on the left and the right versus day 1. And what I think is really important is that in example A, right, let's call them A and B. On day 2 in example A, we had a really nice balance here, which we came into contact with. And so when we're trading in this open space early on, there's not really anything we have to look left in this simple example and lean on. But when we start to interact with this balance area, now we have something we understand and we can use to trade. Maybe it was the retest of the value area high in C period. Maybe it was when we look like we kind of start to compress into this area and start to maybe even hold underneath it somewhere in H period or something like that. Looks like it was a little messy, it was a little above and below. But now once we start to get our shorter term trade setups that we're holding underneath this area, we're reverting, that type of stuff. I'm getting ahead of myself here. But as opposed to example B over here, where, this value area is not really a good representation, is it? Why is this value area not a good representation of balance? That's because it's calculating all this junk. I don't know why I drew that like a figure 8, but I didn't mean to. It's calculating all this junk where there was no balance. And so it's trying to kind of calculate more of that when really we should probably cut this profile in H period and get a balance area that looks something more like this. So with that said, as we look at day 2 and we look left at what we can use to trade, we have no balance. And so this day we were pretty in the dark in this simple example. We didn't have anything. Balance is all we understand, guys. Look left, find balance, attach value, laws of market dynamics, rinse and repeat. I don't use any notes, but I do like to be able to click on something else. Price recently accepting inside a balance area will attempt to traverse that balance area. Putting together a course. Well, you know, am I going and cherry picking examples from 3 years ago, the one instance where this happened? No, this was yesterday, okay? No problem. A period pushes in, and then we traverse the balance area and value. This is a nice value area for 2 days ago. This was yesterday. Boom, revert across. And that was all she wrote, right? And it's more of the same, rotational, getting into more laws of dynamics here. Price recently accepting outside of recent balance often leads to that continued price expansion, imbalance, trending in that direction. Well, here's yesterday, remember that little guy there? But look at what's happened leading up to that. We break from balance, we head higher. We break out of this balance, we head higher. Here we start balanced, but then ultimately we do break and we see some expansion higher. Ultimately, we start to see some value overlap, right? Not really as nice and clean. And guess what? That leads to a lower break, which leads to expansion. And then, as you know, this day was just totally balanced. Oh, excuse me, other than an attempt early, which failed, which led to our reversion law. I can look at these charts and know exactly what the story that's been unfolding, leading us into giving me context for today as I prepare to trade. Price often retests areas. So we've got our balance. We broke in A period. We went all the way up to here. B period comes all the way back and retests that point of that breakout, and then C period takes us higher. Ultimately, it didn't do much from there, but that's still a good trade. Again, A period was a form of a break. In this case, it was a gap, and we come up and we kind of test, and we probably trade down a bit, and then B period comes, and again, it tests, and ultimately we can't hold inside that area. So you get a retest and then go. Not picture perfect examples. These are real life examples of this stuff playing out. We expect more of the same until proven otherwise. Let's go back to yesterday. Once we hold and retest and we're traversing this area and this type of stuff, we're rotational, we're balanced within this prior balance and value. We expect more of the same. Here, we're breaking down. We retest and confirm that. We expect more of the same. Price often reverts to prior areas of established balance. That was all nice in your little gold steering wheel example, brother. But what about real life? Okay, let's take a look. We got some balance here. And then we come in and we form some balance over 3 days here. And when we break, we revert right into this old one and we chop around in it. We break higher after failing to go lower here. We break higher, and where do we build some balance? Right back in this balance. Ultimately, we break again. The next day kind of reverts, and we start to build some new balance and whatnot. And in fact, we build all kinds of balance in this area. Should have highlighted it. But then what happens when we break This time, we go to the previously untested area that we had. That was some old balance. Revert back into that guy. In fact, we rip-roared higher out of there, though. We reverted to it, though. What happens when we revert back up again? Well, we come back to this balance. What happens when we revert higher? Oh, this guy over here we hadn't been to yet. Revert into that. Spend some days balancing up here, and we're going to head lower. Where are we going to head? Oh, prior balance. Happens all over the place. All over the place. Over and over and over again. Do I ultimately know? For example, do I know that, let's continue extending this balance, right? When we break down from this area here, we break down on this day here, were we not just going to go to this one? Why did we just go to this one? You're just cherry picking? You know, no, I didn't have that because we started to build some new recent balance and we'd already retested this one. So I used a lot of fresh areas rather than repeating them. And you'll see some rationale for that and whatnot. But no, I have no clue if we're going to revert to this one, or you get the same exact type laws of market dynamics as you traverse other balance areas. If A or C period or whatever would have just come down here and then started to bounce or chop, then yeah, I'm not expecting us to get here. But as soon as we start to hold below this balance area, maybe we retested it on the short term, well then yeah, I'm expecting to revert to the next one. So we take it one piece at a time, and we do find ways of learning to see what the most important balance areas are. Auctions are often choppier. Again, yesterday, chopping inside balance. Spectrum of opportunity we can use yesterday again. This was the ideal opportunity. Early morning short after a failed attempt higher. We come in, we retest. That's the short. And guess what? This was the destination. The law of market dynamic completed as it traversed the balance area. And now what law do we have? Well, it's just more of the same, choppier inside the middle of balance area, those type things. Opportunities dwindling. But that fresh condition change from an attempt to go higher with the failure of that and then the retest, that's a fresh condition change of attempting to go imbalanced and reverting to balance. So that means it's really good high opportunity. But then once that's just more of the same, yeah, could you have shorted the next test up here? Yeah, maybe you find that opportunity. But, you know, didn't even go back down to the lower edge. It's lower opportunity. Huge, huge, huge concept there that we're going to take way more from, you know, than just once you traverse a balance area, there's less opportunity. That's just a basic example to get you understanding it. It's going to be the same in so many different ways. Many laws of market dynamics have a shelf life to them. They only exist through completion of that dynamic. And multiple laws of market dynamics can be occurring simultaneously. It's not just one at a time. Exception to the traversal. Strong POC rejection, right? This is a weird K period here. Just kind of forget that it's there, but it happens, whatever. But, you know, A period opens up, we test a little higher and we see, okay, we're not breaking out. We're coming back down, and multiple times we can't get through this point of control. And perhaps C period gave us a really strong rejection. D period can't get back there. You know, it's off to the races, and it leads to some expansion higher because we couldn't have gotten through there. This was just a weird K period sell-off. Last half hour of the day, some fun stuff happens. Compression, I think you already get it, right? It's a lack of excess into the balance edge, and it signifies a higher than normal probability of an actual condition change. Composites, this is what we're really here to get to today. A composite is a thing made up of several parts or elements. We will make composite profiles by combining several profiles into one. There you go. We're going to use that new composite value area. Get used to this acronym, CVA. CVA is a way of life for us. We talk about CVAs all the time. as well as CVAH and CVAL, right? Composite value area high, composite value area low, or just the composite we typically refer to as ACVA. It's a major part of the NADRO methodology. So we're now going to use multiple days. Where is balance persisting in a market across time? Then we'll look to apply all our examples so far of like, here's law of market dynamic 2 or 3, and here's the thing. You've probably had in your head, oh, that's yesterday's profile, and that's today's price action. But the way we're mostly going to look to use this stuff is when I drew that second law of traversing an area, the way I want you to begin to see, when I draw that, that's a CVA. That's a multi-day balance, and this is a day coming in and holding back inside and going to the other side. So we'll take all these days and we'll put them together, because guess what? This is kind of a complex example, but it's not going anywhere, right? This market's not going anywhere. It's balancing. So we can make a composite value area or profile out of that. We're not the only people to do this, okay? A lot of people use standard periodicities. They'll call it a composite profile because for some reason, but really it's just a weekly profile or a monthly profile. Not good enough. A lot of people use what they literally call a custom composite from a major recent inflection, or not necessarily recent, but from a major inflection. That's also not good enough. The reason why that's not good enough is because now you're putting so much information into this composite, your value area is no good. So that leads us into how ours are different. We're looking to find the only thing we can understand, which is balance. Where is their balance? And let's create custom composites where there is that balance so that we get good read on value. I was just about, I was telling myself, go find that slide where you said that thing and show them that, because this is really, and here it is. Identify balance so we can calculate value so we can understand. Finding and creating composites. It's going to be a key skill for you to develop this week. Find where balance is persisting. Okay, how do we do that? Look at where the main balance areas, forget value for a moment, okay? Just look at where those fat distributions are really overlapping, where the value is not migrating much, okay? It might migrate a little, but it's not like gapping higher by 5 points, those or 50 points. Those aren't even touching remotely, so there's no balance there. I don't have a mathematical formula for you for this, okay? But I can tell you, once you get some experience and whatnot, if you're like any of our other students, there's a little bit of an art form to it, just a little bit, but they rarely disagree on where CVAs are. So that should just give you confidence that this is going to be quite objective. It's not this like hokey pokey magic, whatever crap. It's objective, and you're going to compare your notes with other students and their preps and talk about best practices and why you did what you did, and you're going to get better and better and better. And then pretty soon, you're not going to have a whole lot of disagreements as to composite structure. That is absolutely true and absolutely awesome. Guidelines for making CVAs, okay? 2 days, each having balance of their own with a clear 50% or more value overlap between the 2 days, all right? That might look like this, to give you the most perfect example that could ever exist. Those days are going together. We're going to merge them into one profile, which we call a composite. Now, rarely does it happen like that, right? It's real world. So a lot of times it's going to look more like this. Oops. Something like this. What's the value area overlap? Would you guess on this one? Right? I'd call it 65% overlapping. So it meets our 50% or more general guideline. Both of the days have balance, so their value areas are good to use. Right? If one day is like this, and its value area is this, and the next day is this, and you'd say, aha, there's 100% value overlap. It's an inside day. Of course they go together. Not really. I'd prefer to look at this market from the perspective of this zone on day 3, which we're about to have, right? We don't have it yet, being most important because it's most recent. It's a really nice distribution. And then maybe some of this up here. Doesn't look like there was much there. But I'm not going to merge all those together and then come up with some weird like overall value area, which might look like that. So they both have to have balance, and those balances need to overlap. Here, there's no overlap in the balances. They're all separate. Rule number 2, if you will, for making CVAs. Keep merging following days into the existing CVA that you've built as long as balance persists. So if we have, let's say those two, whatever days, doesn't matter, they're pretty good balance, and we end up making our CVA from that, and then day 3 comes in here and it's like this, well, guess what? It's going in. It's going to be part of it. If day 4 is here, well, guess what? It's going in as well. We're going to have a whole 4-day balance, right? As long as the days are not changing condition, right? Let's look at what we wouldn't merge, right? Well, you got a day that looks like this now. Well, guess what's occurring here? This market is breaking down. So what if there's a double distribution, right? It depends on where each of those distributions are. And we're going to look at some examples like this, but if you had one that was maybe the first half of the day was balancing and then we broke and then we did this, well, we'll split and we'll put the first half of the day in with the CVA, and the second day the second half of the day will be left alone. If, however, the double distribution occurred totally inside here, then I'm just going to merge. I'm not going to worry about it. It's just a couple shorter term balances within the context of overall balance. So it's just more balance. Let's put it all together. Sometimes 3 days show clear overall balance after days 1 and 2 did not. In this case, we make a 3-day CVA. So sometimes you might have, day 1, maybe day 2 is mostly like this, and you decide, you know what, there's no value overlap, we're not merging them. Great, good decision. And then day 3 comes in here, and it is something like this, who knows? But what's really important is this here, which is really showing First of all, like you at home, zoom out with your eyes. What's going on here? Oh, the market's gone nowhere for 3 days, right? So don't forget to zoom out and just kind of see that. But if you do want to get granular, this day 3 balance was really overlapping part of day 1, overlapping half of day 2. And if you're unsure about it, merge them together and see what it looks like. And if it remotely looks like, it might not be perfect, right? It might have some little wiggles to it or whatever. But if it forms a decent single distribution and it has a decent value area that looks like it makes sense for that distribution, it's probably a good merge. You probably did it right. If, however, you had day 1 like this, day 2 like this, and day 3 like this, and we merge those, it's going to look like this. And you're going to have a value area that looks like this. And that doesn't work, does it? That value area doesn't make any sense. We essentially have single prints in the middle of 2 distributions. That's not an overall composite value area. That's not an overall nice balance to make a CVA from. So it's really nice. It's important with the days 1 and 2. Just because days 1 and 2 don't form a CVA doesn't mean that after day 3 or day 4, you don't decide, you know what? We're making a 4-day. We're not going anywhere. Let's test it. And here's the second really important point. Test it, right? Just merge them. You can undo your work. It's not permanent. Merge them, see what it looks like. And if you got something that looks good like that, use it. If you got something that looks bad, don't. When a large number of days where a market's essentially gone nowhere, we'll consider making one single larger CVA. I kind of alluded to that with my 4-day example there, but typically you're going to have multiple CVAs. Okay, so I'm just going to start getting quicker at drawing these, like balance, balance, balance. You have a 3-day CVA, and then you came up and you had balance, 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 right? So you're going to have a 3-day CVA here, a 3-day CVA here, and then let's pretend there's 20 more days and it does this. Right? Well, guess what? Consider making a 20-day. Especially the messier it is within an overall kind of bracket. You will have a choice, and this comes down to time frame. If it's really nice and tight, like the first examples where it does this, and then it does this, and then it breaks and puts in a couple days here, I would continue using those individual areas. They're really nice areas. You can trade off of them. It's just really good. But like I said, if it starts to become so jumbled up rather than very distinct areas of multiple days of balance, and in fact, if I could go back to the very first slide, like that, right? There's no distinct like multiple days in a row that's like, that's a clear balance, and then this is distinct clear balance away from that. It's just all jumbled up. Consider merging them all together. After you build a large CVA using the logic we provide, do not look left and merge that older day that was previously not part of the CVA into the CVA. Okay, so you had a day here, and then you had this, 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 and it tried to break, and then it got messy, and it didn't really go anywhere, and you ended up making a large CVA. Well, now you look left and you say, well, that's right in the middle of this CVA. I should just add it too. Don't do that. Never look left to merge. Only always look to the right to merge. Simple 2-day CVA. I right click. This is going to keep repeating. It's like a little GIF. I right click on the first day and hit merge with next. And there you go. There's a 2-day CVA. I could have right-clicked on the one on the right and hit merge with prior, but that's not the way I've chosen to do it. I always like to think left to right and work in that direction. Simple 2-day CVA. Look at these days, how their value was 100% overlapping. They each had decent balance areas. They go together. There's no question. It's a 2-day CVA. Keep merging as long as balance persists. So I've got these first 2 days. Okay. Well, look at day 3. It's merging. It's balancing still within the first 2 days. Hey, look at day 4. Its main balance area is still within the CVA. And then the next day was totally away from it. Let you see that one more time. There you go. Look at that big poor high up at the top. All 3 of those days went to the same high and didn't break it. We would look for that area to get completed, right? That auction cycle, not necessarily done up there. Probably going to come revisit that at some point. 2 days no merge, right? Kind of an iffy situation there. Not going to merge them just for this example. We can right click and do a merge profile begin up to the profile that we want to end it with and say merge profile end. Or you could have just clicked merge with next twice. I was just showing you the Sierra chart compatibility. Nice little 3-day balance. You see the profile looks good. The value area looks nice compared to the balance. So compared to balance and value and CVAs and all these kind of things, how much weight would we give to a poor high or a poor low? The answer is much less. That is an individual profile feature, single prints, poor highs, poor lows, a very prominent point of control, those type things. They're, really poor highs and poor lows is a lack of excess, and it signifies something which is secondary to the main narratives that we come up with based on our CVAs, based on our laws of market dynamics. So a poor high or poor low is just like an extra check in our favor or something to give us concern about taking normal law to market dynamics trades, structural trades. So always remember to weight those things appropriately. Large number of days going nowhere. I just gave you 2 images here to show you. We could merge 1, 2, 3, 4, 5, 6, 7 days all together, and it gave us a decent distribution. It's not perfect, is it? Right? We've got this little low usage area there. But other than that, it's actually pretty perfect, right? But, it's real life. It's not like picture perfect. A lot of times with these low usage areas, just as a little bonus tip, a lot of times you'll see a day come in and fill those in and put something there, and then you merge it and it looks perfect. The more and more perfect these start to look, the more ready they are to blow. It's called composite maturity. And so we see this day, it's a no merge because we opened, we tested around a little bit, but ultimately C period, D period, we break and we rip higher away from that composite. But the point is that a large number of days, even though they didn't really appear to have nice day-to-day balance, almost none of them, in fact, right, had much value overlap, but you begin to see a large number of days that go nowhere. Take a look at what it looks like. If it's decent, use it. We will use CVAs as our main read on what we call structural narrative. We'll introduce other ways of reading narrative complementary to this. But where we start right here, right now, is with learning to read structural narrative. So one thing that I do is I'll draw, and I have a hotkey for it, so you didn't see me like click anything or pull up a menu. I will draw an extending rectangle. Forget about the second half of that video where I cut it off. But it's important that we draw where these CVAs, composite value areas, are. And then I will go into my chart and I will map over that drawing to my intraday chart. And in fact, we should do that right now. Let's make another chart and I'll bring it over. Open new intraday chart. Crude oil. Just bring it over here. Put them side by side. I like to have a crosshair. Okay, so this is chart number 12. So what I'm going to do is go to this chart, chart settings, advanced settings 2, copy chart drawings from chart number 12. And actually, let's go to advanced settings 3. No, that's somewhere else. Don't worry about that. Okay, didn't do anything because there is no drawing. Well, this is current crude oil. What do you see? I see a 3-day balance, don't you? Let's merge them. Yep, today. What happened today, right? That's what happened today. We broke into, we retested, and we went to the other side. Let's merge these. Now, I'm going to highlight. So Control D for me is my extending rectangle. So I click once, and then I go down to the lower edge and I click again. Hey, check it out. So there's our level that we can look at our shorter term charts and not lose perspective, not forget where our structural narrative comes from and all that good stuff, right? Unsure about a merge decision? Oh, I can't tell if I should or not. It's like exactly 50-50 value overlap, and there's a little extra distribution hanging off the end. I don't know. So if you've got this, and then the day 2 looks something like just very confusing. You're not sure. It, you know, halfway tried to break out and halfway didn't. I will take day 2 and I will let it show me what the day looked like in terms of how it developed. And if it looks like this, what happened on this day? What was the story that unfolded now that we can see how it evolved over time, which you can't do with volume profile, by the way? We can see, aha, it started balancing inside the composite value area, and then it broke and it retested and it went. So it had some early balance and then it broke. In that case, I'm going to leave this separate because in general, maybe what we spent most of the time doing this day was trying to leave the composite. So I'm not going to merge them because I don't think that the majority of that day was indicative of further balance. If it would have happened the opposite, to where there was, maybe we gapped up and then it looks like this. Let me close there or something. I am going to merge because this was a reversion to balance that occurred. And so I feel like that's really what's happening in this market. So I'm going to merge these. CVAs don't last forever, guys. We don't just draw those magic rectangles and then that's what we trade on until, we die. That's not the case, as you might have imagined. When an area of established balance becomes in conflict with a new version of where value is, we stop using the old and we rely on the new. So let's say that this was a 5-day CVA and then we break higher and all of a sudden the market starts to come back and then actually starts to balance in this area. And we end up with a new 6-day CVA like this. Are we gonna use all of these levels? No, we're not. We're gonna cut off the old, and we're gonna use the new. Especially this area, which used to signify the upper edge of a balance area, value area high, this is especially gone. We are not going to use this. This is good. This is good. This is okay. This now becomes a minor area for us. The main balance is the most recent one. We cut off anything that was, conflicting with the new one. We can kind of keep track of this one now as like if we do, let me just neaten this up here. Okay. If we do break this down and we do get short, this will be just a minor inflection, right? We're not using anything from the upper edge anymore of the old one. So we have to learn how to build CVAs, merge and no merge decisions. We also have to learn where to cut off the old ones and stop using them. Practically charting them, here's that same video. I draw the rectangle, I go right click where I want on the rectangle, and I select cut drawing here, and it stops it. I like to see the history of the CVAs, so I don't just delete the drawing. I cut it off to keep it from showing up on my intraday charts that I have things mapped to, or my CVA charts so that it would get too messy. But I like to see that it was there. General guidelines for this is when a new multi-day composite forms and a prior edge of balance, just like I drew, becomes in the middle of the new balance. It's not an edge anymore. It's the middle. It's a high volume area, not a low volume area. So we stop using it. Or number two, a little more vague, a little more ambiguous. When an older CVA seems to just largely disagree with where there are new areas of excess. So what does that look like theoretically? We had this old CVA, and all of a sudden the new CVA looked like this. One here, and we say, okay, this is pretty much the same levels. We can keep using everything. And then we have another one that says, this is here. Well, now we're definitely cutting off this one, right? We're not going to keep using it. And so you start to see what used to be an area of balance, right, has shifted in the market. Now we have balance here and here. What is this area that used to be balance? It's the opposite. It's excess. And so we're just going to stop using this thing, even though, and in fact, we could have made the example even better with the lower one and drew it like this, where there's actually no value overlap between composites 1, 2, or 3, but 2 and 3 are telling us this is no longer an area of balance based on more recent structure. So that happens less often, but it is something to be aware of and note that we will use it. So here's just, a screenshot of some charts of mine and whatnot. Where did I cut off CVAs? Okay, I cut this one off because its value low became the middle of a new balance. We could continue to use this one and look at where this day held on top of was that area. A lot of times I will actually delete the upper and lower like secondary lines if I ever draw those. I will only though cut off old CVA structure. We have this that formed. We have then this one that formed. This was one of those examples where it starts to become unused, but we'll get to that later. And then we drop down and we just balance in between these two balance areas. So really both of these levels are fine. We don't have to do any cutting because really they're just confirming, hey, that is the edge of distribution 1 and distribution 2. It just happens to be the upper edge of 1 and the lower edge of 2. So it's a great edge right there. We'll continue using that level. I don't care that they overlap a little bit. It's the same area. All good. And then we gap up and we balance here. And then we get to an interesting component where it's almost like we decided to cut off a couple. We cut off balance 3 and balance 2 because of balance 4 right here, right? We start to identify, okay, this is a lower edge area. This is an upper edge area. So for us to think that balance still persists into this zone doesn't make sense. And then this is a pretty clear cut here as we develop a new balance in the same general vicinity. That's just an update to the old one. So this level is obviously not the upper end of balance anymore. It's smack dab in the middle of balance. We stop using it. So a couple straightforward examples, with this one being the most complex, where we got rid of several of them, even though this one, let me clear some drawings. This one didn't actually have any value overlap, any conflict with the new balance, did it? But we have excess, and it's not balanced anymore like it used to be. So we stop using it. We will not cut off a CVA based on 1 day of balance. If we have an upper edge and we have a day that balances, that we're not going to cut it off. Now, we can also get advanced on that. And if you start to have multiple days, which like this example, here's day 1, let's say, and here's day 2. Both of these days balance across the upper edge of an existing CVA. So it's an interesting thing to consider. Would those cancel out the effectiveness of that CVA? And they could. But 1 day alone will never do it. If you start to get multiple days, you need to research further. And how do we research a profile further? We split it out. And by split it out, I use the wrong term, but that's what I call it. We separate the columns. And if you've got columns that look like this, where it literally just doesn't care about the CVA level, and that's happening multiple days, you can cut it off. However, let's say day 2, for example, what you'll find a lot of times is that the market actually still really cares about that area, and it looks like this. It bounced off of it and formed this upper part of the balance. And then it broke through, and then it retested, and then it drove lower a bit and then balanced. This market really cares about this level despite its profile looking like this. So we can look further for more information when that rare example of saying, hey, do we need to cut this off because of a single day or 2? Doesn't happen often, but that's a great thing to consider. More examples. Upper edge from an existing CVA. Well, we can back up a little bit. This one I decided to cut off because what? Well, we got a new boss in town, new sheriff in town. We drive higher. Where does this old one that we can't see get cut off? Oh, right here, because a new balance takes over. Could we continue to monitor this level? Sure. Secondary level. Balance here. We come down, we form a new balance after some further, well, that was just a single day, excuse me. And guess what? Here's an example of me having a real chart showing you exactly the way I do it. I cut off the old one because the new one is here. We cut this off. But I still care about this lower edge. And so I just extend a single line drawing on that lower edge. So if I'm looking at a CVA and I see a single line, I know what that means. That's an old CVA where I cared about that outer edge as a secondary level. If it's unclear, don't stress out over the perfect answer. Sometimes a profile spent half the day balancing and half the day attempting to break balance. And there's not a really good place to split or something. And don't get too crazy with splits. We'll talk about that. Some days there's just not a great answer. That's okay. Don't forget, you can also use the prior day's balance areas in addition to more important overall CVA. It can help you get into a narrative as a second chance entry. What do we mean by that? We have a 3-day CVA, and I'm going to show you what the third day of the CVA looked like. Maybe it was like this. What if you don't get this trade? It didn't exist, right? It didn't look like that, whatever. Well, guess what? You might could get into this trade as a second chance entry using a prior single day's distribution within the context of the rejection from the lower end of the composite traversing the full composite. You can use individual days in addition to, complementary to, not against CVAs, but complementary to CVAs when you get those trades. We'll talk more about that, but that's just a little early indicator. Sometimes it's a simple matter of choice, whether to keep several 2 to 3 day balances or merge them all into a 10-day balance, just like I talked about. If you want to get a higher time frame perspective, merge them as long as the distribution looks decent. We talked about that. If you want to keep a more granular, lower time frame view, keep your simple 2 to 3 day merges. You could even look at them both and have an idea of what both are telling you. It's fine. Splitting profiles, we've talked about why that makes sense. Take a look at this day in the middle. It's got 2 distributions. The first day balanced within the CVA, and then the second half of the day broke. I merge the first half with the CVA and leave the second half showing that it broke. We'll watch that one more time. Nice arrow. Okay, 2 days that are balancing. We're going to merge those. And now we have 1 day which has balance, but then breaks lower and then balances. So what we can do is split that right there in I period, right there. Merge the first half of the day with the CVA, adjust our CVA to be the proper value area, and now we're left with this, which, by the way, now has a good value area attached to it. Best of both worlds. Look at this value area on this day. Terrible, right? That is not value because we didn't attach it to a single area of balance. All right, we're bringing it together. We're learning to speak the language. What can we do with all this? Remember all this stuff we talked about, the risk-reward landscape, having objectivity, seeing what the market's up to, learn to speak the language of narrative, garbage in, garbage out, where things are invalidated, where that condition changes. I'm hoping that as I read off every single one of these, you know already based on what I've told you today. Context is king. We have not yet discussed a single thing about when or how to enter a trade. We're focused on where to trade. Remember Linda Raschke. This is where we trade, why we're even considering a trade, why we're looking long or why we're looking short. Narrative comes from auction market theory, our laws of market dynamics, and where we're currently trading relative to recent structure, aka balance. There is no structure when you have just a trend, right? It's just a long, skinny profile. Structure comes from the fat distributions. Where possible, we want to arrive at a read. Where possible, it's not always, but we want to arrive at a read on the narrative. What is it up to? What's the story unfolding? Learning to speak that language. When we do get a good read on narrative, we have a bias, long or short. We have a structural risk-reward framework we understand, and we understand where the market is attempting to head to. And we know where it all falls apart, where it all changes, where a market attempting to go imbalanced up would fail and then be reverting across a prior balance. That would be a shift in condition. Those are all the pieces you need to judge risk reward and opportunity at hand in a market. Now, there's varying degrees of quality of a read on narrative. Number one, recency of the reference, right? Yesterday's value area high is more important than the value area high from a month and a half ago. The more recent, like the last 5 days are like crude oil right now. The past 3 days, as we saw, have formed a 3-day CVA. That composite value high is more important than an older composite value high. The duration of the reference also matters for structural narrative. A 10-day CVA is more important than a 2-day CVA. As we auction relative to these areas, the recency of the change in current condition matters. Remember that law around how opportunity is different and dissipates and all that good stuff? And remember, we used an example from what was yesterday where we tried to go higher, we failed, and then we retested, and then we went down here. So there's your prime opportunity. Why is it prime opportunity compared to maybe getting long from here? Well, that's because at point A, we've recently had a shift in the condition. We were trying to go imbalanced up and we failed. There's your shift in condition. And it's pretty recent. This is the first retest of this area since that happened. That's A+. This, however, there is no shift in condition leading up to this potential trade opportunity. Yeah, we have a law of market dynamics that says expect more of the same until proven otherwise. So we do have the expectation of this being a potential long opportunity, but it's a B trade, right? It's a C trade because leading up to this, there was no shift in condition. If we'd gotten a shift in condition like this, well, then that same trade location would be, again, A+. This is the destination, as we call it, from that law of market dynamic completing. So there's less opportunity. So therefore, it's a lesser trade. It's a lesser quality of narrative when you're going to say, here's my narrative for getting long here. My narrative is based on the fact that we're rotational in a 3-day CVA, and I'm going to buy the lower edge. You need to know that quality of narrative is not as good as you saying, we have a 3-day CVA we just failed to break out of, and now we're retesting the upper edge. I'm getting short. It's A+. And then clarity with confluence and dissonance. It's not going to be as big of a deal right now, but we'll talk more about that. Do you have multiple factors contributing to this being a really strong area to trade from? Or do you have dissonance where some things say you should be bullish, other things say you should be bearish? We have less clarity, more dissonance. So those 4 things is how you come up with how good your trade idea is. Like we said, I may have actually covered all these slides now, actually, before we get to them. Yesterday's balance is more important than a balance from 2 weeks ago. Our immediate CVA is more important than older CVAs. A 3-day CVA or a 2-day CVA is more important than a single day because it has a longer duration. More days comprise it. A break from a 12-day balance is more significant than a break from a 2-day balance. Again, recency in change of condition. The more recent, the stronger our narrative is. If we just accepted back into a 5-day CVA in the overnight session, overnight comes in right here. I'm looking short. I'm going to have a bear level on my prep right here. I'm looking to get short. What if, however, the overnight session was just doing this? I might have a bear level here, but that's not nearly as good as that fresh condition shift leading to that potential bearish level. Here's a good one to talk about. Well, we'll do both of them. So number one, we'll draw it below it. We're breaking back into a CVA while also breaking out of a PVA, prior value area. Here's our CVA. And here is the prior day. The prior day tried to break the CVA. What if we got this trade? Right? What if we got this trade? Well, it makes sense on multiple laws of market dynamics across multiple profiles. On one hand, it's a reversion into our composite value area. So we have that law. It tells us we should go down here. And on the other hand, on a shorter term basis, it's a breakout outside of the value area from the prior day and a retest of that. So on one time frame, the lower time frame, we're getting imbalanced down out of our prior value of the single day. And on the higher time frame, it's a reversion of balance after a failed attempt to break it. But they agree with each other in terms of bias. So we have confluence. What about an example where that's not the case? Let's say we have a 5-day CVA, and here is the prior day. What do you think about getting long the breakout of that prior day? What about that trade location right there? Well, it makes sense. We're getting imbalanced. It's one of our laws of market dynamics. We're breaking out of a balance area, so we should expect that to, go. Well, what's the slightly higher time frame context? We are absolutely running out of risk reward as we push into the upper edge of a rotational multi-day CVA. Those are dissonant. Not a great narrative. Where would things align? This would be an area of dissonance between these two. Things would align when you break the CVA as well. Now you've broken the prior day and the CVA, and you're good to go. Enjoying drinking from a fire hose? Ultimately, we get a read on narrative so we can distill down the information into our current scenarios for the session, what we call our hypos. Hypotheses, right? This is going to be a handful, typically 3, I think is a good number, of if-then scenarios. So putting this into practice involves making CVAs where we can, where they exist, reading the narrative and the strength of it by applying our laws of market dynamics and whatnot. Ultimately, all these different trades I keep showing you, there's only 2 of them, aren't there? 2 main A+ structural, narrative, contextual, quote unquote, setups. There's only 2. One we call a breakout pullback, a BPB. The other is a return pullback, an RPB. Let's go back to our 10 laws of market dynamics. Number 2, price accepts into a balance area. It traverses that balance area, okay. 3 is when we accept outside and we continue. And number 4 is where we get retests where those condition shifts occur. So we're going to combine laws 2, 3, and 4 for these setups. So for the long, I know you know this already, but we're just clarifying for everybody. Price recently holds above a balance area after having come from inside it. We look to get a retest. We stalk long opportunity for this, right? That is a breakout pullback, and you want to get in somewhere around here. A return pullback is the opposite, right? It's a mean reversion trade instead of a imbalance type play. We were, in this case, below our CVA, and we break back into it. We look for the retest. We know the law of market dynamics says we're going to go to the other side. So we look for that shift in momentum. We get long. That is a return pullback. Return pullback. These things don't happen perfectly. Let's go ahead and address that. You might get a return pullback that looks like this. You might get a return pullback that looks perfect. You might get a return pullback that does this, right? Whether it's above the level, right at the level, just below the level, it's an area, okay? We're still not even talking about placing trades. We're still framing context. We're still being alerted to the potential of trades. Example 1. This circle, as you can see right here, is where we're about to open for the upcoming session. Let's hear it in the chat. Wake up, everybody. What are our basic hypos for this day with no other information than just as it stands, as you can see what's in front of you? You know we're currently trading as we're about to open. What could be some hypos for this session? Let's hear it. And I would prefer new students, not any existing prior students, to answer this. Yes, we're opening in balance, David, but what's the hypo? Cole says we could have a breakout pullback of the composite value high. That's true, but that would be a secondary hypo compared, because think about it. In order for us to get a breakout pullback of the composite value high, we're right here right now. So what you're telling me is we're gonna break, and then we can do that. And I agree that that's a hypo, but as Hayden is saying, we're balanced until proven otherwise. So what I think our best hypo 1 is right now is going to be for, you know, we're opening near this level, so we can use the level we're near. That's something that's a part of doing hypos, actually. You know, that you're not going to say, well, I think this level from down here from 20 days ago is my hypo 1. No, because there's going to be a bunch of other things that happen before we get to that. So the sequence of events is important with your hypos. Hypo 1 is going to be for some kind of a test up into here, and our rotational state remains, and we would look for a move across. Hypo 2, I would agree with Cole. We come up for this inflection. Maybe it starts to work. Maybe it doesn't work. Maybe it blows right through it. Who knows? It's a bunch of random market movement, right? Ultimately, it does break, and we do get this retest, and we get that. I think that's hypo 1. I think that's hypo 2. Hypo 3, I think Cole also mentioned a breakout pullback of the composite value low. That could be true, but this is going to really, it's those two hypos. Those are going to be like the strongest for the session. Hypo 3 here, it's really more of when you'll see me. I talk about a level in my daily market insight I'm really excited about. This is what it's all about. And then I'll say, well, and if we get down here, we'll monitor the inflection. That's kind of how I feel about this, because if we get down to the lower edge here, which by the way is the only way we have more hypos in this simple example, we're either going to remain rotational, which I would say should be our first hypo 3, or hypo 4, if you will, would be we ultimately break here and we get that trade, right? Hypo 3 long is not so good because less opportunities on the table to get advanced with you right off the bat, right? This is a destination from hypo 1. So therefore, there is less opportunity. Not to mention this market's going to be heading down pretty sharply and things like that. So I'd prefer actually to wait for a fresh condition change as my hypo 3 here and really see a nice trade that makes sense with everything else that we've talked about today. Here's what did happen. Okay. Here is the profile we were just looking at. Here's where I told you we were about to open. Here's what happened. And here's a short-term price action chart to also show you. I highlighted this level that you can see going across here. That is the composite value high, just so you know where that level actually was. So we got hypo 1 right there. We got a short into the retest. But this low here stopped right here. We didn't make it to the destination. We jump back above that point of control and push back into this area right here. And then we break. And now we're into hypo 2 mode where you could get long here, there, there, there. You take this breakout here. You know, like there's short-term ways of getting into trades. Ultimately, we didn't get a perfect retest, did we? Nothing came back to the actual level of the breakout. And that happens. That happens. Okay, one real example. Example 2, I'm going to ask for hypos. Well, first I'm going to ask a question. So not hypos yet. Hang with me. The circle is where we're about to open. What pieces of narrative information do we have? What's the story unfolding? What do we got? What is the story unfolding? Failed break, return to balance, balanced until proven otherwise. If break from CVA, look for breakout pullback. Likely to be choppy opening in the center of value, just returns back into prior value. Okay, so we're starting to get some pretty good answers across the group here. I think what a lot of people are seeing here is, look, we had a multi-day balance. We broke. We then had a multi-day balance. By the way, anytime there's these drawings, that means it's a CVA. I only draw the drawings on my CVA chart where there's CVAs, okay? And then we broke lower, and then it looks like we closed here, and in the overnight session, we've actually gone here. Great job. That's the story that's unfolded from what we can see on this chart. We balanced, we broke higher. We balanced, we broke lower, and what did we do? We reverted to a prior area of established balance. Now, what about the hypos? What are our basic hypos for this, given that information? Is your hypo 1 going to be a breakout pullback of this old composite value high here, given that we're opening right here? No, it's not, right? DVA is never a component of any hypo, Nathaniel. Okay. Typo. You're still driving, aren't you? That's fine. Composite value low retest? No. Rotational in PVA is correct, but more specifically, what would be would you rather get long from composite value high as we're rotational in here, or would you rather get short from, wait, let me say that again. Would you rather get long from composite value low, or would you rather get short from composite value high? Short, see? And why is that? Somebody give me the best answer of the day. Be very, very happy. If you're not a long-time student, close proximity, not good. David says most recent. Most recent what? David's close. Fresh change of condition. What happened overnight? What happened overnight was we closed here. We did this, because think about it. The second half of this day, this was that day we split and merged from another example. And we balanced on top of this old CVA. But the most recent thing is a breakdown from this CVA. So we're bearish in general. Now we're just interacting with old structure. The breakdown from this is what's most bearish. And now what happened overnight, so this was first condition change. And now we've had a new secondary condition change overnight, which is a break into this structure. So the very best trade we could take, guys, would be this return pullback to get this. That's going to be a strong hypo 1 in this scenario. Other hypos could be to get long here if we can't accept into there. But we're more cautious about hypo 2 because the main thing that's happening on a composite level is the fact that yesterday was a day 1 break lower out of a CVA. And then another one would be a nice, again, move if we see continued sell-off in strength. Again, we might remain rotational. You might see a long opportunity from this composite value low. But remember, that's a destination, right? If we get this trade, that's a destination. That's not an A+ fresh condition shift narrative type trade. What if we come in and we've got our hypo 1 that we've gone through here? We're opening right here. What if price just does this? You start cursing under your breath at Merritt for the bad methodology? Cole with a beautiful answer. We practice mental framework. We understand that we're not always going to get our perfect retests, and markets are just going to drive off the open, and it happens. Destination achieved without us. Guess what? One of the things that's actually going to happen to you with this new level of understanding, going to that informed trader, you're now going to see what the market's up to all the time. Not all the time, but a lot of times. And a lot of times it's going to go there without you being able to trade it. And that's going to be frustrating. But guess what? You wouldn't have known about it before, and you'd just be still flopping around in the dark, so it doesn't matter anyways. You've got to, you're going to get a good framework with Edge, and there are going to be setups from time to time that work very nice for you. Yeah, if that did happen, again, this is an inflection. It's a destination, so we don't love the long. We'll take it, though, especially if it tries to break and then kind of pops back in and then gives a weak retest. We're happy to get long. We're rotational, right? Well, this is where it gets complicated. A little more complicated than I wanted to get today, but we're going to do it. We're not really rotational. We are rotational, but really what's more important than rotational in this hint, older CVA? We're first and foremost bearish because the most recent thing that's happened is a breakdown from our most recent CVA. So that carries some bearishness to it. That's another reason why I'd want to see something more. Just because we got to the older level of an old structure doesn't mean it's a long. This is a breakdown. This is a market that's not only breaking down from CVA, but it's breaking down other levels as well. And just because it gets to an edge of a balance, you're going to tell me you're just going to hop in front of the train and get long? You want to be careful with that trade. Here's what happened on this day. Here's that upper edge. Look how long you had to wait for that trade. In fact, right off the open, I think I should have had this drawn, but it looks like it's hard to tell. But I'm guessing that the lower edge of this CVA is like here. Something like that, maybe a little higher. So it went down to it, and then it failed to break it down and stabilize. So we could have gotten that little long. But Even if you do that, you need to keep in mind context that we still haven't gotten the retest up here. And that doesn't come until all the way over there. So you could have gotten long here. You could have gotten long here. Small little scalps. You need to think of them as against the main narrative. But we could still find opportunities for that. But this is very advanced talk. I want us to stay on the basics. Overall, we finally get this retest, and this is where you want to be shorting. The further you chase it away from that level, the worse the risk to remaining reward is. Not a perfect example, right? This is real life stuff. Key idea. For any and all references we might ever lean on for a trade or narrative, think areas, not lines. Areas, not lines. General zones, not a specific to the tick level. Use them with less precision. Composite value high, composite value low, whatever the reference might be. It's not precision stuff. It's general stuff, general areas. Wait for it to clearly show you it's breaking, something's changing, and then shift. Example 3, circles where we're about to open. What structure do we have to work with here? We can see the prior 2 days. It is in between the distributions from day 2. Well, the thing I want to, yeah, exactly, Rosie. We want to split this profile. We want to make a 2-day CVA. And then we're going to have a really nice main level. And then this is just a little something up here. We don't really care about it. But yeah, if you can already visualize the 2-day CVA, then hypo 1 is that, right? Okay, there it is. What are our basic hypos? We just kind of talked about it. We come down for this inflection, I think, right? Long is where we're looking. If that fails, obviously we could take the short right here, but this is really what it's all about. This is the destination. This is just some basic structure up here, very minimal. This is one of those days where it comes down to one really key kind of area and whatnot. And look, you almost had to wait all day to get it. Could you have gone with some early longs as the market just looks like it's driving away from this area? Yep, you could find some ways to do that, but it's risky. The safer bet is waiting for that inflection, either getting long as momentum shifts there, or waiting for that next pullback after it really shows you, especially when it's something like this. Circles where we're about to open. What's our basic hypos? Well, we can't see that there's been any really important condition shift, right? So it's really just rotational, and we're at the lower edge. So I'd probably look to find a way to get long somewhere if this is going to hold. Or if it breaks down, then I'll find a way to get short. This becomes a destination. This becomes the destination given the older structure. Yep. Yeah, and in fact, regarding overnight action, notice all these examples. I'm not saying here's what happened in the overnight session in terms of anything further than here's a circle where we're about to open because of where the overnight has taken us. So it's really a non-factor at this point in time in your development. So example 4, what happened? We immediately drove and broke, right? We were expecting to maybe get some longs off this area, but what happened? We broke it immediately. And then in the mid-morning, we get our hypo 2. right? Maybe you put a short on here, maybe it stops you out. Maybe you re-enter the trade or something like that in one of these spots and you catch it. Maybe you take this little tiny thing here, if more of an advanced type play. But either way, things are sloppy. Things take multiple entries sometimes to nail, which is something we'll talk about as we get more and more advanced. And where does it go? It goes to the lower edge or the upper edge, I should say, of an older CVA. And then it rallies like crazy from there, like the crazy market it is. But we don't expect that. We do not expect that. This is an inflection to see what happens. And again, we're bearish. We are bearish, guys. Why are we bearish? Because this is the recent structure and we've just broken it down and we've retested it and we're heading lower. So I'm not going to sit here and tell you this is a place to get long because it's not. If I were to readjust my hypos, if you will, as while we're right here coming into that area, hypo 1 is for us to break and give me that trade. Hypo 2 is if it fails. Again, I need to see something more. I need to see a failure because it's more of a destination. So it might try and then it might fail and then it might retest weekly and that might be where I look to get long. Maybe. Which we kind of did that a little bit. Depends on what happened on order flow here, whether or not we'd ultimately take that as an advanced student. Balance is what we can understand. Find balance, apply value. Where we are relative to recent balance gives us laws of market dynamics we can use to determine opportunity. Remember, there's a spectrum of opportunity. Understand the strength of the narrative, those 4 points. Identify potential breakout pullbacks and return pullbacks that could unfold, that align you with the narrative and those laws of market dynamics, one and the same. Develop your hypos around those potential scenarios. Now you're armed with an understanding, an overall strategy coming into the session. What's the market up to? Where would that change? Then what would the opportunity be? That's all we've been doing. All right. What are we going to do this week? You probably aren't an evolved human trader yet. Continue to make time for mental framework. Don't get lost in CVA world. Don't forget week 1. Never forget. That needs to be our hashtag. Never forget. Week 1, mental framework. Well, we're going to work on developing your profile prowess. That's important. Stay honed in on balance. Connect value to where there's good balance. Seems simple, but it works really good. Always know where there's excess or lack of excess, right? That has implications. Think about auction market theory. Think about that example. Toyotas. Always know where there's excess, lack of excess. Where has change in the current condition recently occurred? Remember, that has implications for narrative and strength of it and where something has changed. So therefore, where our bias has changed or whatever. Can I identify a likely destination the market's working towards based on the laws of market dynamics? Where would the current condition change? Get as many reps in as you can at seeing all this stuff play out, developing if-then scenarios and hypos. This is all the stuff we're going to be doing. So first thing I want you doing is practicing building CVAs in hindsight, historical data. Load up 200 days in your chart, scroll it all the way to the far left and get to work. Okay. So start with somewhere. You have to pick a day. I'm at point A here. Pick a day and don't look left, just only start looking right from there. You have to make that choice at some point in time. So it might as well be one day or another. Make a decision to merge or not to merge that day with the prior balance. If you have a merge situation where you create a now we have a 2-day CVA, draw your extending rectangle from it. If you don't have a CVA yet, proceed as normal in terms of hypos and all the stuff we've been doing, but just use the prior day's value if it's a good value. If it was just a big elongated trend day, remember, nothing exists. That day might as well not be there. And so you might as well just go pick another day. Move to the next day, right? And begin the process again. Consider the scenarios. Let's say that you do have at least a day with balance, if not a 2-day CVA. At point C here, consider scenarios for the upcoming day you're about to analyze, just like we walked through with those examples. Might get a breakout pullback here, but just don't think in simple terms like that. The first thing that pops into your head, remember how we were getting some guesses in the chat and I said, no, think about what's most likely. Think about, are we mostly bullish or bearish based on recent rejections or whatever? All that good stuff. So come up with smart, hypos and whatnot. Now, for the next day, so we've got day 1 and day 2, which we merged, let's say, for a 2-day CVA. Now that you're done thinking of what day 3 would look like, even if you can see it in front of you, right? Don't worry, just think through the scenarios. And now to really go in and double check what happened relative to what you thought might happen or could happen, point D, select letters blocks in own column, right click the day and then select that. Look at how it unfolded, right? If you've got your 2-day CVA and you had a profile that looked like this, well, now split it apart and take a look. Did it come up into here and then maybe break, and did it give you a retest and then go higher? What happened? Learn from that rep. Oops. Need my drawing tool. Make sure I read all this with you here. Look at how the day traded relative to your CVA or PVA if there was no CVA. See what laws of market dynamics happened. See what breakout pullbacks or return pullbacks happened. What destinations were hit, right? Do it all. Where did the condition change, if at all, from balance to imbalance or whatever? Then collapse the day after you're done analyzing that day. Collapse it back into a regular looking profile and go back to step B, which is essentially introduce day 4 in this case. I'm sorry, not yet. I'm sorry. We had days 1 and 2, which we formed a 2-day CVA. Now we look at day 3 and we go back to step B. Now we're done analyzing it and what happened and understanding it. Now we have to decide, just like I have to do right now for, getting ready for tomorrow or whatever. Does today, quote unquote, in this case, quote, it's not really today, but your today, does it merge or not with the existing CVA? So there you are. That's a huge rep. Merge or no merge. In this case, we drew a difficult one, but let's pretend that it was an actual breakout for the most of the day. And so it's a no merge. And so now we look at the next day. Take a look at where that opening colored print is and say, okay, And by the way, let me teach you something additional real quick that I just noticed that you might want to know. Remember, we can use prior value as a single day in addition to composite value as second chance entries. So in this case, when we're opening right here on day 4, I think one viable scenario here is we actually hold prior value, because guess what? The whole day yesterday was spent breaking out of the CVA. That's kind of already been done. So hypo 1 for me would be that we actually just test and go real quick off of prior value. Hypo 2 might be that we do get the full CVA retest. You see? Now, if I do get long here, this is a good place to scale. It's not a place I'm going to short. There's some dissonance there. We failed to just cleanly break out of prior value, even though there's an overall breakout pullback occurring on the CVA, in terms of prior value, what just happened? A return pullback, right? But because the CVA is here, this is still a really good long opportunity. Unlike if it was a PVA just in isolation, that's just a likely destination area with limited opportunity. The CVA changes that. So complexity right there for you. But it's important that you make that merge, no merge decision and do what I just did. We start up with hypos again, and we go through the process again. What can you see unfolding with our hypos? What happened? Split the day out into its own columns, analyze it, likely destinations, what happened, blah, blah, blah. Now collapse it back, merge or no merge with the prior structure, if any, and repeat over and over and over and over and over. Bunch of reps. Daily hard right edge. This is kind of that's work you can do any old time, right? You could go tonight and start that work. But then I also want you to get some hard right edge work, not the hindsight work. Hindsight work is great right now. Everyone develop hypos before the open. Obviously, you know that you're going to see mine, with crude and the S&P. But if you trade something entirely different, maybe do the S&P with me so we can compare notes. That's what my nightly reports to you guys will come. So you can double check your work, share in the room, but do yours before you go to the room and look at what others, okay? Use the room to double check. I tell all my students, that are fully NADRO educated, don't look at my hypos before you do yours. Use it as a way to double check. And so you guys do that with each other. So post them in the room, right? Once you're done. And then compare notes and see if there's learning opportunities for you or someone else. So develop your hypos just like we've been doing. Don't worry about getting it perfect. Just try. This stuff is a lot of trial by fire, right? I've given you really good best practices and all kinds of stuff, but you're going to have to get dirty with it to really get it. Then trade the session. I'm going to give you, we're going to get the trade here, okay? We don't need our VWAP filter anymore. The slope of VWAP, we don't need it. Use our long short bias for our hypos based on our market profile, structural narrative stuff, to be whether or not we're looking for longs or we're looking for shorts. Or maybe we're in an area where we're looking for nothing, right? Continue to use the Heikin-Ashi bars. Look for those 4-bar minimum pullbacks, and then that turn, that change in the Heikin-Ashi that makes sense with your hypos, and then put on a trade. One lot, stop goes beyond the swing. Don't move your stops. Don't trail your stops. And your targets, I give you dealer's choice here. It can either be a likely destination or you can come out quicker. If you see yourself wanting to be more of a trader, kind of like me, and no, maybe you don't know yet, but it's fine. Alternate between 1 and 2, right? If you don't know, fine. But if you see yourself wanting to be more of a scalper and you already know that, then do more of number 2. If you see yourself wanting to be more of that intraday position trader for longer holds, do more of number 1. Experience them both, though, is what I would suggest for most people. Maybe if you want to get more complex and you think you're ready for it, pick number 1 if you think you have really good clarity on your narrative read and let that thing run, right? Or if you're not as sure about it and maybe there's more limited opportunity, then do number 2. Okay, you'll have this recording to look at all these rules of what you're doing here. Yeah, Patrick, you could you could definitely do that. I would prefer people being forced as part of the learning process to experience getting out and it continuing to run and that hurting, And I would like for people to experience this week keeping it the likely destination and having it go halfway there and then turn around and stop you out. I actually want you guys to experience that pain. You will become stronger if you experience it. So that's why I said pick one as the suggestion for the drills. Guys, that is it. 3 hours in here. Thanks for sticking around. This is going to be a really cool week. We're starting to see things. Week 1, we're learning how to see clearly. Week 2, we're starting to learn what to look for. So, continue doing executions with affirmations, right? You could build on that. Keep doing that as you're trading the session and whatnot. So, could be great. All right, everyone. Cheers. Get to work, use each other in the room, compare hypos, talk about pros and cons, and I will chime in from time to time. Not making any promises there. We'll save some stuff for the Q&A. But where there's really uncertainty and you guys can't figure it out, we'll come in and say, well, this would be ideal. But there's going to be some advanced students in there that can help with a lot of that. Cheers.